Okay, so we're looking at Barings BDC. Now this is an externally managed BDC, and I would say it's an average BDC. Now the question that you may be asking is, when I'm always preaching about quality, when I've been talking for the last 6 months about quality, why might I be adding this BDC when I'm saying it's only around an average quality BDC? Number one, obviously I do the income. And number two, even an average BDC can do well when and if we are able to leverage some of the gains here from a normalization to a normal price to NAV ratio. Now, when I look at BDCs, I often use this free BDC Universe webpage, and we can see Barings BDC on this alphabetic listing is near the top. Now, it's important to note that this is a fairly long-lasting BDC, so IPO date was 2007. And one of the key metrics I like to look at is this NAV total return of 29% over 3 years. So that's about 10%. That's not bad. Now, in terms of where that falls, it is unfortunately not in any way, shape or form the sort of the best of the bunch here, but it is a sort of, as I said, it's average. It's not wonderful, it's not great. If we look at the first to second lien proportion in the portfolio, again, it is near the middle of the pack, so it's not the safest, but it's also not the worst either. So why care about this? Why am I looking at this so carefully? The biggest thing I'm looking at here is, despite the fact I think this is not a bad option, or not a great option, is the fact that it's trading here at a 15% discount. Now, in essence, what I'm saying with this BDC is I can capture a nice market yield here of over 10%. I'm assured at this rate that their 3-year return is going to be reasonably good. I know that the company itself has a reasonable proportion of first and second lien loans on their portfolio, so that gives me a reasonable level of security that if their portfolio companies are not doing well, this company will still be in a fairly good shape. And over the next several years, this premium slash discount of 15%, I believe that's going to close, and I believe it's going to come closer to on par, where the prices and the net asset value are on par. Now, if we flick over to the payout content here for Barings BDC, this is an externally managed BDC, and that has some implications which we'll go over next. And the important thing to note here is when we look at it in terms of some of their peers for the net asset value, we can see that yes, their red net asset value here for Barings it's increasing, yes, but it's not increasing particularly quickly. We can see the expected COVID dip here, but we can also see some other dips in net asset value as well over the last 10 years. This is not a sort of an increasing machine like I think the superior or the best run BDCs are. So I'm not expecting great things from this investment. But if we begin to add the price on here, we can see it generally has traded at a discount here. There's been a time here in 2021 where it was pretty much bang on par. The discount widened down here. I wish I'd had the foresight to purchase at this point. And the discount still remains very wide today, particularly given this boost in the net asset value. Now, the NAV has increased a little bit in the last quarter, and the modest level of increase here, I think, is really down to some of the net realized losses on their investments and some of the foreign currency transactions. And there was also a $12.7 million loss from restructuring investments over 2 portfolio companies. So I think that this is important for us to look at. So there are some reasons, again, that it's not the greatest performer here. Again, this is why I'm saying it's just average. When we look at industry exposure, it's got a reasonable exposure here, although the financial services is a little bit on the heavy side. If we run into financial difficulties across the wider economy or a recession, that could be a section of their portfolio that would be more readily damaged and more at risk. IT software, not unsurprising, it's a reasonably good one. And then the rest of it is fairly diversified. Asset exposure, 65% first lien or senior secured, and then second liens or senior subordinated is another 6%. So reasonably safe there. Now, what is going on? Why has the company sort of been struggling here? And that's one of the, I think, really interesting is an externally managed BDC. Now, the parent company here is obviously Barings. Now, they've had some issues over the last year where they've had a reasonable loss of some of their employees who have left Barings and moved to a competitor. And I think that's had a knock-on effect here for Barings BDC as well. So there's been a loss of human capital. There's been a loss of expertise. And I think that's shaken and rattled some of the investors here a little bit. But as I say, look, I'm not too worried here. The net asset value is increasing. They do a moderately good job, and there is this discount here that I believe will close with. Now, continuing the discussion around Barings BDC. But turned to the Koyfin platform here, and there's a couple of things that I like to do in Koyfin that I cannot do easily elsewhere. So the first thing I want to do is I've looked at the last 5 years of data. Now I've got that in BBDC Barings here in a thick blue line, so hopefully that's nice and easy to see. Now this is in terms of total returns. We've got the S&P plotted on here for reference at purple, and I've got two other what look like assets here. Now this is a special feature of the Koyfin platform. The superior BDC performers and the BDC seconds. Now, straight off the bat, if you look at these two lines here, then the BBDC and BDC, that more or less they have followed the same sort of pathway here. TS here crashed down quite hard. We can see in general this purple line representing the S&P 500. I'll just make that a nice thick dotted line. It doesn't really work so well, does it? Dashed line there to differentiate it. That did crash, yes, but it also recovered very quickly, very strongly, and has gone on to power forward. As we look here, though, with the COVID crash, we can also see what's happening a little bit more here is the S&P 500 has bounced back after COVID. We can see that in all cases, whether or not it's what I call the blue bloods or the superior choice here for BDCs or seconds or average BDCs like BBDC, Barings, hard, and they took a while to recover. Now, I think one of the interesting, the blue bloods here recovered harder and faster than the other categories of BDCs, and as we can go over time, we can see that the superior choices here and what I term as the quality BDCs, they've recovered faster and in many cases actually outperformed the SPY, and as time goes on they powered ahead, and then the S&P 500 actually began to catch up with them quite a bit. It's a couple of really good options. Number one, you could just invest in the SPY, but look, the blue bloods here, the superior BDCs. Here again, I'm opting for the Barings BDC. I recognise it belongs in this category very much as a sort of an average BDC or a slightly second-rate BDC in my mind. As the discount buying here. Now the other option is an ETF. Now one of the best ETFs here is the Van Eck BD ETF. Now I'm just going to put this in a different color than the normal color here, just to try and differentiate it a bit, and we can see the sort of the patterns here. It's between the superior performance of the blue bloods and the BDC seconds. Generally, I'd say when you look at the BDC here, it's a reasonably solid choice. It gives you good income, and it's going to put you somewhere in the options in terms of the ETFs. But there's a couple of other things that I think we do. So I'm going to use some of Koyfin's very interesting. Okay, so as I said, I separated out the these into two categories, and what Koyfin enables me to do is it enables me to create a model portfolio, which is what we saw on those charts of performance. Essentially, it allows me to create a sort of a synthetic. In this particular case, I have a number of BDCs that I think are good quality, and I've given them all the same weight here, adding up to 100%, and we can see visually what that looks like. Now, the more important thing here is when we look at the performance chart, we've got rolling annual returns, and we can see at the zero level, rolling annual returns over 10 years for a 1 year period. We can see there are superior returns compared to the S&P, but there are also periods of underperformance, as we saw after the COVID crash, where they're not doing so well. If we switch this to a 3 year, and I don't have the data to really go back too far, we can see a 3 year rolling return. We can see it matches the S&P 500 and has slightly superior returns overall. But look, more importantly is some of these historical returns here. You can see months of negative performance, and we can see months where it has been hammered, and these are the months that are scary. These are the months that will keep you awake at night. Now, obviously, that's the COVID crash. It is once in 100 years, but there'll be other issues, other times in the market where we have similar or comparable problems, where you're just going to go, crikey, what have I done? Now, that's important as well, because when we add a look at this risk element here, we can see these drawdowns. Now, here in blue, this is the drawdown here, and these are the better BDCs. And we can see a lot of the time the drawdown is comparable to the grey drawdown for the S&P 500 for most of these periods, but it was here during this drawdown. And we can look here and we can see a drawdown of over half. So basically half of the money that we would have invested into this collection of superior BDCs, that's lost half its value. Now that is absolutely scary. Now if we look at these quantitative metrics, there's a couple of key things here that it does. It's got the top drawdowns here, as well as the recovery time in days and the length of the drawdown here. And I love this stress test as well. Now, this doesn't go all the way back because I've only got the synthetic Blue Bloods ETF here that has only been set up with full coverage over all of those stocks. But if we look at this, there's the inflation surge here, and we can see that the BDCs did better than the SPY. We can see during the COVID crisis that the ETF here essentially got smashed, and BDCs lost half their value as opposed to the S&P 500 losing a third of the value. And during the Q4 volatility spike 2018, we can see that there is very comparable performance. So what does this mean? It means it's probably going to be more volatile in bad times, or at least as volatile as the S&P 500. So by itself, it's not sort of a great sort of risk management option here. I would need to pair this and match it up with some other assets in my portfolio to correct for this, or balance this out a little bit. We can see here Sharpe ratio, it's not any sort of better or worse than the S&P 500 ultimately, but one of the key things here in my mind is simply the income, and the income you can get from these BDCs can be substantial, and it can make a really nice impact on your portfolio. Having a 10% income, some of these pay monthly, most of them pay quarterly, but that, my friends, 10% per annum income from your BDCs, that is nice. And as we begin to look at Barings BDC as an option, it does have nice income. It does have reasonable NAV growth over the years that I expect to continue. It's seen poor price growth here, but I'm going to be holding this potentially for many years, so I'm not too worried about the slow price growth, but it does have the good income. It does have a reasonable portfolio. It's been reasonably managed. It gives me the option right now to buy it here at this discounted rate, and I'm taking that option. So I've just started a very small position here at the end of the week, at the end of the month really, in June 2024. So what do you think? Is this an interesting BDC for you? Is it one that you want to look at? or is this one that you'd avoid and you'd just go for the higher quality options? Now, it's always important, my friends, to think about safety, to think about the dividend safety and the likelihood of dividend cuts and how you can and make sure you're doing the right thing to keep your portfolio safe. And if this is interesting to you, then I think you'll really enjoy this next video right here now.